All right, so in this video, I'm going to talk about the statement of cash flows. The statement of cash flows is for a period of time. So it's always incorporating a period of time. That's similar to the income statement, but in contrast to the balance sheet. The balance sheet is for one point in time. The income statement and the cash flow statement are for a period of time. And on the income or cash flow statement, you're going to find three sections. You're going to find the cash flow from operating activity section, the cash flow from investing activity section, and the cash flow from financing activities section. So for the cash flow from operating activities section, on most cash flow statements, it's going to begin with net income. So it's going to start off with your net income as your first line in the operating activity section. And then it's going to make various adjustments to move from net income to arrive at the cash flow that came from the operation. So the idea is that income is capturing kind of the starting point of what's going on from an operational standpoint, but then some adjustments have to be made. Among them would be depreciation and amortization. So depreciation and amortization will be added back to the net income. And the reason for that is they were subtracted to find net income, but they were non-cash expenses because depreciation and amortization are non-cash. So by adding them back, it's trying to get closer to what's actually happening from a cash flow standpoint. Then other changes in current assets and liabilities, with the exception of cash, will be factored in the cash flow from operating activities. So the reason why this is done is if, for instance, a company had a bunch of inventory that they sold during the period, so that's going to be reflected in the income statement information, but they didn't replace it, then they sort of sold down the inventory, then that's going to produce essentially extra cash flow because cash has come in, but no inventory was replaced there. And so by drawing down on those current assets, that essentially is producing more cash flow. Now, what's important with that is to note that that would not be something that the company could do year after year after year and continually deplete inventory. Eventually, they're going to need to replace that. So, and also similarly, if they increased current liabilities, they borrowed more short term, then that will actually increase the cash flow from operating activities as well. But that's not something that they could do forever either in most cases. So ultimately, what you would like to see typically would be a nice, healthy cash flow from operations, but primarily driven by the net income and not the adjustments. If we look at the cash flow from investing activities, the cash flow from investing activities is going to focus on the purchase of assets or the sale of assets. So if assets are purchased, that would be a cash outflow. If assets are sold, that'd be a cash inflow because the assets are being sold in exchange for cash, presumably. So that would be reflected in the investing activities section. Cash flow from financing activities. So cash flow from financing activities will involve the issuance of debt or equity. So if debt or equity is issued, then the company is receiving cash in exchange for that. So it'll be a cash inflow. If debt is being repaid, that would be a cash outflow. If the company is buying back their own stock, so buying treasury stock, they are paying money to buy back their own stock, which is going to show up as a negative in the equity section of the balance sheet. And that outflow of cash would be then a cash outflow in the financing activity section. Also, the payment of dividends would be a cash outflow overall. So in general, when you're looking at this for the cash flow statement, all of these different cash flow items or sections work out to produce the overall net change in cash during the period. And if you're evaluating them, what you'd want to see is generally, typically, some kind of positive cash flow. And definitely, we like positive cash flow from operating activities, primarily driven by net income. We like that. But things get a little bit more interesting if you start kind of trying to look at the full picture. So let's take a look at that a little bit. So some things that we could analyze if we were looking at the cash flow statement. One, where is the cash flow coming from? And as I've already noted, we'd like to see cash coming from operations. That's good. Primarily driven by net income. We like that a lot. In terms of what we would want to see on the other sections, though, that gets a little bit more interesting. So if you start looking at the investing activities section, so the cash flow from investment operations, that gets a little bit interesting. So if I'm looking at a small, rapidly growing business, then they're constantly investing in trying to grow. And as a result of constantly investing and trying to grow, that cash flow from investing activities is probably going to be negative because they're constantly spending a whole bunch of money to buy assets and expand. And that may be completely fine. In fact, that may be exactly what I would want them to be doing in order to grow. On the other hand, if I had a very large, very mature business with very limited growth opportunities, then it's quite possible that I wouldn't necessarily want to see a large amount of cash outflow in the investing activities section, because that means they're buying a whole bunch of assets. And yet, if they don't have a lot of growth, what are they buying these assets to do? Now, that doesn't mean that they wouldn't have to buy any assets. They may need to buy assets to replace assets that they already have that have worn out. But I wouldn't necessarily want to see a huge outflow of cash in the investing activity section for a company that is very mature and doesn't have much of anything for any growth opportunities. Similarly, if I start thinking about the financing activity section, back to the different kinds of companies. If I had a younger, more rapidly growing company, they are going to be buying all kinds of assets probably, so lots of cash outflows from investing activities, and they may be then issuing debt and or equity to try to gain the cash necessary to pay for all that. So I may be looking for a positive cash flow from financing activities, basically because they need to acquire funding to buy all the assets. On the other hand, if I looked at a large, more well-established company that has fewer growth opportunities, then probably they wouldn't be spending as much money on investing activities. And if anything, maybe they're in a situation in which it makes sense for them to be returning cash to the shareholders. And so in that sense, maybe what they ought to be doing is paying larger dividends, doing larger share repurchases, in which case we would have a negative cash flow from financing activities, and that may be completely fine. It may make sense. So when you are actually analyzing a cash flow statement, you need to be thinking about the differences in industries, industry life cycle stages, where the company is, what kind of growth prospects they have, in order to evaluate what you'd really want to see on the cash flow statement. And really what you're kind of asking yourself is, do the corporate choices make sense? Does it really make sense given the situation, what they are doing? If they're buying back treasury stock, should they be buying back treasury stock? Does that make sense from a capital structure standpoint? Does that make sense from a growth standpoint, that they're essentially getting rid of a bunch of capital? And if they've got a lot of growth opportunities, maybe that seems a little weird. On the other hand, if they don't have a lot of growth opportunities, maybe they should be sending money back to the shareholders. Maybe that makes more sense. So you really have to look at the context for the investing activities and the financing activity sections. Generally, for the operating activity section, pretty much we're going to prefer to see a positive cash flow there, if at all possible, and preferably one driven primarily by the net income. That's generally what we're going to want to see. That doesn't mean that we couldn't see something else that might make sense. But generally speaking, that's what we're going to look for. All right, hopefully this video has been helpful. Thank you so much for watching, and have a great day.